Hello viewers, welcome back to our YouTube channel, KC Accountancy Education Center. And today we want to look at gearing and the cost of capital. Gearing and cost of capital. Gearing and cost of capital. Now, as I explained in the previous video, we want to look at the impact. If the company is highly geared, what happens to the cost of capital? Now, this cost of capital has issues that disturb it. And one of the major issues is gearing. And by definition, gearing refers to the amount of debt finance a company uses in its capital structure. Amount of debt finance a company uses in its capital structure. Now, one thing that you need to note is the fact that if the company is geared, if a company is geared, in other words, it has debt in its capital structure, it means it uses debt in its capital structure. However, there are those companies that are not geared, which means they don't use anything to do with debt in their capital structure. Now, if the company is not using debt in its capital structure, it means they are using 100% their own money, whether their own savings, whether their own equity shares. Now, so long as your debt is higher than the equity in the capital structure, then you can say that you are highly geared. So the problem is not being geared. The problem is to be having high debt in your capital structure, meaning you are highly geared. So once you have a lot of debt in your capital structure, your debt is more than. So if the debt is more than the equity, then we can say you are highly geared. That is highly geared. But if your equity is more than the debt, then you are not geared. Now, the paper doesn't stop, what we are studying doesn't stop you from using debt in your capital structure. So, but what we are bringing in is the fact that, or is the concept of gearing that you understand. Because I expect that the more you use debt in your capital structure, you are actually geared. You are a geared company, and we are not against being geared in your capital structure. But we just want you to understand the implications that using debt in your capital structure, it has an implication on the cost of capital. And we want to look at its impact when you have more debt in your capital structure and when you have less debt in your capital structure. Now, we have agreed that as a CFO of any business or the senior finance manager of any business, you are responsible for some decisions as we looked at them. And one of them, we said some of the decisions that you are supposed to do, you are supposed to do investment decision. So you are supposed to make decisions about investment, about dividends, and then financing decision. But we said working capital management is not part of our syllabus. That one we looked at it under the financial management, but for advanced financial management, we don't have working capital management. So, because of these decisions, you need to be mindful if you are a company that is highly geared. So, if you are highly geared and you are supposed to make all these decisions, then you should be mindful because it has an impact on your cost of capital. So, if you are highly geared and you are thinking to raise more funds, maybe using the finance decision, and you are seeking for more money from other lenders, then that might be a problem because as I said, because I told you companies have a ceiling, a maximum that they can borrow. Even banks, they give you that for your company, we can maybe lend you up to 70 or 75 or 80% of your assets. So if you are highly geared, meaning almost your assets are financed by debt, maybe 65% of your assets are financed by debt. That's what we mean by being highly geared. So if you want to acquire more funds through debt, then it's going to be a problem to you. Why? Because of the fact that we expect you to be facing a challenge of people not willing to grant you the money that you need because of the fact that you have very many loans. So if you are highly geared and you need to raise more fund, at least it would be a very good idea for you to think about equity, looking at equity finance sources, because you're already highly geared. But how do we know that this company is actually highly geared? What is the real mathematics that we look at, or what are some of the percentages? We are going to dive into that when we look at the gearing ratios. But for now, just understand, if a company is highly geared, it means its debt finance is more than the equity finance. Now, once a company is geared, there are risks you will face, and there are two major risks. One of them is what we call the finance, or we can call them financial risks. And the other is what we call the operational risk. The operational risks. So there are two when the company is geared. We don't care whether it is highly geared or low geared, but there are risks. One of them, financial risks, and then the other is operational risks. So for examination purposes, we need to take note, because here the examiner can bring to you a standalone number carrying 25 marks, explaining this kind of arguments. So we need to be careful in what we are going to discuss. Now, what do we mean by financial risks and then the operational risks? How are they related to the fact that when the company is geared, you face them? Now, when we talk about financial risks, maybe we start with that. Financial risks. When we talk about financial risks, we are only interested in, of course, first of all, we shall need to first understand what it is. Now, the concern of financial risk is that the owners of the money are likely to get reduced dividends as a result of the financial risks. So the company predicted to maybe to get, let's say, the company predicted to get, let's say, 100 million. This is profit after tax. If you have predicted maybe your estimated profit, this is estimated profit after tax part. But when the year ends, you find that you have made 60 million as your profit after tax. This is actual. So what this means is that even the dividends that you had anticipated, if let's say you were saying that we shall be paying 10% dividend, 10% on the estimated here, it will be 10 million. But here 10% will only be 6 million. Are you seeing that there has been a reduction in the dividend that the total dividend that we are supposed to pay to our people or to our owners? So it has reduced by 4 million because of not achieving what we had planned to achieve. So even the dividend, the fact that the shareholders, their dividends is going to reduce because of financial risks is because the fact that what we had estimated to receive is 100 million, but we got 60. We are supposed to pay them what we have, even though we had estimated to get 100 million, and that will raise maybe 10 million in debt, in dividends. We shall distribute only the 6 million that we have received because we base on what we have achieved. So, because of financial risks, shareholders will have that fear that since we are geared, then financial risks might affect us. These financial risks, because now, what causes the dividends to reduce is because maybe interest was, remember interest is paid, is deducted before paying taxes. So before you arrived on this 100 million, maybe or the 60 million, let's go with the 60 million that we have actually achieved, this 60 million. We first deducted the interest for the people who gave us borrowed money, that is debt. If we never had debt, that amount that we paid out as interest or that we deducted as interest would have increased our profit after tax. And in that sense, we would also have a higher dividend that would be paid to the shareholders. So by mere fact that we have debt in our capital structure, shareholders will be worried that their dividends will be lower. So that's one argument, or that's as a result of financial risks, because they fear to lose money given the fact that they will be bringing in more people in debt. However, the examiner might prompt you to compute financial risks. In other words, they may tell you to compute the risk that is associated with these shareholders' way of losing money. What is that risk? Either in percentage or the ratio, we don't know. We don't know yet until we have done a number. So, the examiner might prompt you to compute financial risk, or what we call gearing associated with financial risks. In other words, we are looking at financial risks based on the fact that the company is geared. We don't care whether the company is highly geared, but as long as it has debt in its capital structure. Because if it is not highly geared, then even the risks, the financial risks will be a little bit minimal. So we don't make any comment. We first compute, then we make a comment that based on this, then maybe the financial risk is a bit lower. So we have to be very careful, because you could be computing gearing associated with financial risks, and later we will also be concluding with gearing associated with operational risks. So these are not matters of level 2. We have now reached to the advanced financial management. So these items, we have not talked about them under our financial management paper on level 2. So these are new areas that if you have just come from level 2 and you're just doing your advanced financial management paper for the first time, these are new areas that you need to focus and have something. So I've said that the examiner can bring a standalone number here. That standalone number, it came, there is a year when it came, it was taking 25 marks. It was, I think 2019, it was carrying 25 marks. A standalone number on this same, gearing associated with financial risks, then gearing associated with operational risks. So in the next video, we are going to look at, first, let's understand what gearing ratio is, or what we call the leverage ratio. So in the next video, we are going to look at gearing ratio. Before we compute, we first need to know what a gearing ratio is. Gearing ratio, or what we call the leverage ratio. Gearing ratio, or what we call the leverage ratio. So I need us to first understand what gearing ratio is and what leverage ratio is, or gearing or leverage ratio are, so that we can be able to proceed to the computations. Because after understanding this, we shall get the formulas that we are going to be using to be able to compute these gearing associated with operational risk and then the financial risks. But I hope you are getting where we are heading. So let's meet in the next video as we are talking about the gearing ratio. We'll see you there.